In announcing increased profits last week, Barclays and equity banks appear to have been operating from two sides of the same coin. Barclays maintained its 2008 strategy of cutting down on new lending and reported a 12% pre-tax profit growth to 9 billion shillings, while Equity Bank managed a 5% growth on expanded lending. However, while provisions for bad debt at Barclays dropped 60% from over 1.2 billion shillings in 2008 to just above 512 million shillings, Equity's provisions headed the opposite direction, increasing 72% to 3.06 billion shillings from just under 1.8 billion shillings, an illustration of the tight position banks find themselves in as they balance the need to lend more to spur economic growth while at the same time growing their bottom lines.
If the government is borrowing from commercial banks at 13% for a 15-year, there's no reason why you should lend to a corporate or an individual customer at below that, because government is risk-free and so on and so forth. So the issue of the CBR then disappears out of the window.
At the moment, interbank interest rates are down up to 2%. The central bank has lowered the central bank interest rate to 7%. And in the medium term and long term, we expect the markets to adjust.
In its last monetary policy committee meeting, the central bank maintained the central bank rate, the lender of last resort rate, at 7%, down from 9% 12 months previously, with the hope that commercial banks will follow suit.
Over time, rates are likely to come down as long as, these rates will continue to come down in terms of an indicator. And there will come a point where they come down so low, inflation picks up, and then they reverse again.
Central Bank has openly sought commercial banks for answers into systemic failures that prevent its signals from being felt in the market. Adan holds that it is inaccurate to peg commercial bank lending rates on the central bank rate, which is a short-term rate, while the financial system offers banks limited investment opportunities.
Commercial banks can only do so much in playing their role in an economy. We need to deepen the capital markets as a way of raising long-term funds.
The interest rates that the central bank is offering, we expect enterprises to start going for bonds, and of course that will drive the interest rates to the market.
To reduce rates, banks have the option to increase lending periods, but then again they depend on short-term customer deposits and would expose themselves too much if they went long-term. While the central bank explores development banking products and engages in economic debates, the customer, it appears, will have to make do with high interest rates and credit that is not easily accessible. Samuel Kante, KTN Business Today.